We're thrilled to have you join us today. We have an excellent presentation lined up for you. Just a couple housekeeping items I wanted to cover with you. This is a 1-hour presentation, and we will be leaving some room for questions at the end. The presenters have also received questions that were left during the registration process. Many of those questions will be covered during the presentation. And if for some reason we're unable to get to your question, you can leave it in the chat box, or we can follow up after the presentation. Early next week, we're going to be sending out slides and also a recording of today's presentation. I would encourage you to reach out if any of your questions haven't been answered, or if you have any new ones after you listen to this today. Our marketing team is also posting an evaluation link. It's going to be posted about 5 minutes before the end of our presentation. We appreciate your feedback. We always try to, strive to improve our presentations. And you can leave it anonymously if you'd like. So just wanted to let you know that will be popped into the chat box about 5 minutes before the end. Our presenters today are Gregory Estes and Josh Hahn. Greg is a senior portfolio manager and also a relationship manager here at MBI, and he has 30 years of building successful client relationships, managing portfolios, developing client investment strategies, performing equity research, and leading compliance-based risk management strategies. He helps oversee the wealth management goals of MBI's high net worth clients by cultivating relationships and providing customized research, analysis, and informed guidance. He is a chartered financial analyst, one of the industry's highest distinctions in the investment management profession. Josh Hahn is a senior investment analyst here at MBI. He has nearly 10 years of financial service expertise included in the fixed income arena, alternative assets, and consulting for institutional and private clients, and asset liability modeling. Josh works with clients to review their portfolio risks and performance outcomes set against benchmarks, analyzes model equity and fixed income funds for client portfolios, and assists in other areas of financial planning. Please welcome Greg and Josh, and they're going to start their presentation. Thank you.
Well, thank you very much, Judy, for that introduction. On behalf of Josh and myself, we want to thank all of you for carving time out of your busy days to participate with us in this webinar. Just very quickly, this is a webinar brought to you by May Barnhart Investments. We are a full-service wealth management firm that offers financial planning services, retirement planning services, et cetera, and investment management services, which this webinar will really be a part of the investment management service that we offer. So we will mostly be talking about the investment markets in this presentation. MBI is a subsidiary of Counselor Buchanan and Mitchell, which is a full-service accounting firm helping clients throughout the DC area, the Mid-Atlantic region, and beyond. So just briefly want to give you an overview of what we will be discussing today. And we'll start with kind of the big picture in the economy itself and in the central bank, the Federal Reserve, and this notion of the soft landing. What does it mean? What is the soft landing? What are the conditions for that? Are we on our way to a soft landing? Then we will kind of delve into more of the market, the equity markets, how they've looked over the past year. What are some of the fundamentals of the market, and how do those impact the market, and what are our expectations in 2024 as we look ahead? And then we're going to spend some time with the fixed income market. The fixed income market has changed dramatically over the last couple of years. So we think it's important to devote time to that because it not only covers bonds themselves and bonds as investments, but the idea of interest rates, which impacts really everything. So before I get started in earnest, I just wanted to share with you I have an idea for a movie. So I'm trying to cash in on the superhero craze out there. You've heard of the Avengers and the Justice League, and my thought was maybe we should have a movie about the League of Central Bankers, and it would star Christine Lagarde from the European Central Bank and Kazuo Ueda from the Bank of Japan, and our very own Jay Powell, who is the chairman of the Federal Reserve. And you can see he's got his magic power scissors there as he's ready to cut interest rates, or at least we think he's going to be cutting interest rates in 2024. But kind of joking aside, um, the to read some financial media, they sometimes it feels like they are almost ascribing superpowers to these people. And it's not really that these people have superpowers in and of themselves. It's simply that the structure of their institutions has a lot of power in that they control the buying and selling of government bonds for their respective countries and regions. And they control short-term overnight interest rates that banks lend to one another. So there's a lot of power there. Incidentally, I don't think my movie would work very well. Not a lot of action, only a lot of monetary action. So probably wouldn't work so well. But the idea behind the central bank that gets a lot of press for the idea that they have superpowers is that they are orchestrating a soft landing. So what is a soft landing? Well, the idea of a soft landing is that um, we can slow the economy down just enough to bring down inflation. Now, in and of itself, bringing down inflation is good, but really what the market's hoping for is by slowing down the economy without putting it into recession and reducing inflation, you get to the point where you can then cut interest rates, and that would be conducive to positive movement in the equity market. So what are some of the conditions for a soft landing? Well, first, the economy has to be softer, but still growing. If it's slowing down too much and goes into recession, that's not a soft landing, that's a hard landing. The labor market needs to be robust, but not too hot. If you think about the labor market as an analogy, the machine is the economy, and the labor market is one of the important gears in there turning. If it's turning too fast, if it's running too hot, it's creating a lot of friction, it's creating a lot of heat. That's inflation. So we want the gear to turn, but we don't want it to turn too quickly. So robust, but not too hot. And last but not least, we need to have signs of declining inflation. It's no wonder with conditions like these that sometimes the soft landing is also referred to as the Goldilocks scenario. So let's look at these conditions and see how we are progressing. So the economy today, how is it looking? Is it slowing down? Well, the chart on this slide is showing you what the gross domestic product, what that growth rate has been, and it's on a quarterly basis over the past couple of years. So the purple bars are showing you what's actually happened. And the most recent report was for the third quarter of 2023, and that was a very strong positive 4.9% growth rate, powered by a lot of consumer spending. It was a surprisingly high number. So that would seem to indicate an economy that's running pretty hot. But if you look at the gray bars of what's expected going forward, it's positive. So it's still growing, but it's a lot cooler than what we've had in the past. Just to note, these numbers are real, which means that they are excluding inflation. So these growth rates are beyond what they would be if you added in inflation. A couple of other notes here. The first is that the WEI, the Weekly Economic Index, remains in positive territory. The Weekly Economic Index, I've referred to this in a previous webinar, is really just an amalgamation of a lot of different factors in the economy, the labor market, personal consumption, production, et cetera. And it gives you a kind of a snapshot on a week-to-week basis of how the economy is doing. And that's in positive territory, showing growth. Not extremely high, but in positive territory. Another item of note, the U.S. Composite Purchasing Managers Index, is above 50. So what does that mean? The Purchasing Managers Index is more from the business side. What are purchasing managers seeing out there in business activity? And when that reading is above 50, that means you are in expansion mode. If it's below 50, you are in contraction mode. The composite number means it's a combination of the Service Purchasing Managers Index and the Manufacturing Purchasing Managers Index. Incidentally, manufacturing PMI is slightly below 50. Service PMI is above 50. When you average them out, we're above 50. We are a service-based economy, so services gets more weight than manufacturing in that model. How does the labor market look? Well, the chart on the left is showing you quits and hires. Hires in the light blue, quits in the dark blue. And this is showing you how, what is the labor force doing as far as quitting one job and going to another. And you can see coming out of the pandemic, there was obviously a spike in hires as businesses reopened. But there's been kind of an elevated rate of hires and quits. When I talked about that analogy of the labor market as a gear spinning, it's been spinning very fast over the past couple of years. That leads to inflationary pressure because if you're constantly having to look for new employees and they're constantly quitting, the likelihood of you finding what you need might require a business to pay more, which is lending to inflationary pressure on wages. A second chart on the right is showing you job openings and unemployed. And obviously, the unemployment rate here in this chart spiked massively with the closures during the pandemic, but then came down. But what you can notice is that job openings for an extended period of time have well exceeded unemployment. So there have been a lot of surplus job openings, but that surplus level is starting to close, which means that, again, less pressure on wages, upward pressure, which means that the labor market is coming back into more of a balance. And last but not least, how does inflation look? So this chart is showing you the Fed's preferred inflation measure, which is they call it core PCE. That means personal consumption expenditures. This is a measure produced by the Commerce Department. There's another measure you've probably heard of, CPI, Consumer Price Index. That's another measure of inflation. They're both used. This one tends to be the one that the Fed uses just based on how it's created. So that's showing you that is in red in this chart. You can see it was at a multi-decade high in late 2021, early 2022. It's a core reading, which means that it excludes food and energy. Food and energy are obviously necessary components of living, but because of their volatility, they can make it difficult to read longer-term trends in inflation. So the Fed prefers to look at a measure excluding food and energy. And you can see that inflation has indeed trended downward. What they wanted to do is move to the green line. That is their long-term target for what they call price stability or inflation of 2%. So as inflation moves towards 2%, that's viewed as a very positive sign of declining inflation. The last line in this chart is the Fed funds rate, which, when inflation was very high, the Fed was raising that rate very quickly. Obviously, they were a little bit behind the curve, if you will. Inflation had already gotten up pretty significantly high before the Fed really started to move. But given where Fed funds is now at roughly 5.5%, it's pretty high. And if inflation continues to move towards 2%, it's very likely that we see rate cuts. As a matter of fact, in the December minutes, it was the Fed release. They basically said that they're expecting to cut rates 3 times in 2024. The timing of when that happens really depends. So there are some risks here. If this red line does not keep moving towards the green line, if it moves sideways or for some reason jumps up, that would definitely delay cutting interest rates further down the road. but that remains to be seen. Last part of the big picture I want to cover is that 2024 is an election year. So I know people are interested in looking at how election results impacts the market. And there's been a study done that looks at the the 3-month return after the election and compares that versus long-term historical 3-month periods to see if the average return in these different scenarios, how that matches up with kind of the long-term 3-month return average. There are 6 different scenarios depending on who wins the White House and who controls Congress. And in these examples, you can see they've gotten stated returns for different scenario outcomes and what those average returns look like. But the right column is showing you which of these are statistically significant, which is to say, which of these return periods actually looks different than the long-term historical averages. And it's really only 3, scenarios 2, 3, and 4. And in scenarios 2 and 3, where you have White House controlled by a Democrat and Congress controlled by either all Republicans or split, those show a slightly higher than normal 3-month return. So, and then in scenario 4, where there's a Republican in the White House and a Democratic controlled Congress, slightly below the long-term historical average. If you're going to take anything away from this, it's that single party sweep does not appear to cause any kind of market disruption. Now, I do want to note that we're looking at 3-month returns after an election because it's very difficult to look at longer term. For example, if there's a policy change in tax policy or something like that, it's very hard to attribute that in statistical analysis to how much of that tax policy is causing the market to move versus other things such as market fundamentals. Incidentally, I do want to note one other point, and that is what does tend to move the market more than outcome of elections is data that shows either declining or increasing inflation. Declining inflation shows a higher than normal return. Increasing inflation, not surprisingly, shows a lower than normal return in the 3-month period. And growing economy tends to show higher return than a slowing economy. Again, those are pretty intuitive. So let's get into how the equity markets have looked in 2023. They finished very strongly for the year. I wanted to show you the last 2 years of Morningstar style boxes. So if you look at the box, the top row is large cap stocks. You move down in size to mid cap in the middle, down at the bottom, small caps. And then if you read from left to right, value is the leftmost column, then core style in the middle, and then growth on the right. So 2023 was in some respects kind of a bit of a mirror image to 2022. 2022 saw rate increases on part of the Fed, very strong rate increases that kind of hampered stock prices, more impactful on growth-oriented companies. That is to say, those companies that have more deferred earnings as you're looking for earnings growth down the road, but maybe not as strong earnings in the current periods versus value stocks, which are sort of the reverse. They're paying you now. They're not going to grow at as high of a rate. One thing that is interesting to note is while the large cap growth led the way with a 47% return for 2023, if you were in large cap growth over the last 2 years and you compound those 2 rates together, you still end up with a net negative, which is to say you've had a very volatile experience. The reason I note that is sometimes it's important to step back from simply one calendar year and look at longer periods of time to kind of get a sense for how things are working. But, with the idea of rate cuts, we didn't have any rate cuts in 2023, but the very idea of them was very powerful and helped propel the market upwards. particularly those growth-oriented businesses. So I want to show you how 2023 fared in a different way, which is to look at 3 different indexes that are split by size. So the blue line is showing you the S&P 500, which is a large cap index. The red line is showing you the S&P 400 mid cap index. And then the green line is showing you the S&P small cap index 600. All of these indexes, if you look to the left of this chart, are showing you they start at 100. That means ground zero. 100 is a 0% return. You start the year, you haven't made any money. And then over time, you can see that beginning in basically in March, large caps led the way with a higher return. But by the time we get to the end of October, this isn't exactly a market that's going to wow you. The S&P 500 was a year-to-date return a little bit under 10%, but mid caps and small caps were negative at that point. So they're below that 100 level. But then something funny happened. That is to say, we showed lower inflation numbers. We showed a cooling labor market. We also saw expectations for reduced economic activity, still positive, but cooling. What were these? These were our signs of a soft landing. And the idea of the narrative of the soft landing is very powerful because it led to expectations in the market that the Fed at some point, what they're doing is working and they will be cutting rates, which is really positive for stocks. So you can see all 3 of these took off. Obviously, the large cap segment won the day. It was well over 25% return for the year, but mid and small cap stocks themselves really started to rally very strongly in the last 6 weeks of the year. So I want to take a look at how rate cuts impact stocks from the perspective of the rate cut cycle. That means when the Fed starts to cut interest rates, which they haven't done yet, we're not sure when that's going to happen. Josh is going to talk a little bit about when that might happen, when the market's expecting that to happen. But when it does happen, what do returns look like in the S&P 500 as an example? So every bar you see that moves to the right is a positive return. And basically for almost every period where there's a rate cut cycle, the market rallies. The average gain in the S&P 500 during rate cut cycles is about 20%. There's only that one outlier, and that was a very different scenario. Yes, rates were being cut, but there was also this dot-com bubble. There was actually a bubble in asset prices that was bursting at that point. So that prevailed over the rate cut cycle during that period of time. A very unique period of time, if any of you were around to experience it. I was there were stocks that no longer exist today that had ridiculously high multiples simply because they were going to sell their products on the internet. One other point to make about the rate cut cycle is that the S&P actually shows a median decline in the first 3 months prior to the rate cut, to the first rate cut. So what that means is, the market's still unsure during that period of time about when the rate cut happens. Once the rate cut happens, the market does tend to perform positively. We see this a lot of times with uncertain information. The market will tend to be more volatile before the information comes out. Once the information comes out, the market assesses it and then moves on from there. So looking ahead in 2024, because I know we get questions like this, well, how is 2024 going to look for stocks? And well, we can't be certain. We do know, obviously, that last year was very strong. So it's very challenging to replicate the kind of numbers we saw in 2023. But there is some positive news, and that is that earnings, the expected earnings per share for companies, is expected to grow in 2024. So if you look at these different bars, what they're showing you are earnings per share growth estimates in the case of the light blue ones. Those haven't happened yet. And then the dark blue are actual earnings per share growth numbers. And you can see in late 2022 and 2023, we actually went through what is sometimes referred to as an earnings recession. We had negative growth or declines in earnings. So why am I making a big deal about earnings growth? Well, earnings growth supports stock prices. I'll give you a really simple example. Let's say you have a stock, it's XYZ stock, it's trading at $10 a share, and it earns $1 per share. We would say that the price to earnings ratio of that company is 10. Now, let's say the stock moves up to 50%. It goes up to $15 a share, but the earnings per share is still $1. Well, now that stock is 15 times earnings. So when we talk about whether a stock is expensive or not, we need to be clear. You say it's cheap or it's expensive. You're asking relative to what? In my example, it's relative to the earnings power of the company. So in that prior example, let's say the stock moves from 10 to 15, but the earnings per share moves from 10 to $1.50. Well, the stock price has appreciated 50%, but the PE is still 10 times. It's still just as expensive or cheap as it was before. So earnings growth can absolutely help support stock price increases. Whether it can support the kind of the kind of market rally we had last year, that remains to be seen. But the fact that earnings are growing is definitely a positive sign for stock investors. So the equity market, we've talked a lot in the past about the Magnificent Seven. You probably read a lot about it. I mean, they really won the day in 2023. But what's interesting to note is since the market began to turn in mid-November of last year, that those equity returns are starting to broaden out. And what I want to show you is the chart on the left is showing you the cumulative returns starting from that rally. And it's showing you in the yellow, the Magnificent Seven's return over that period of time through the early part of January, and the Russell 2000 small cap. And you can see that it isn't all just Magnificent Seven that's getting positive returns. The small cap has started to show signs of life and is getting positive returns as well. On the right, what I want to show you is the difference between the S&P 500 index and the S&P 500 equal weight index. What's the difference between those two? Well, the S&P 500 index is dominated by the biggest companies in the index. What are those biggest companies? They're the Magnificent Seven. They account for almost 30% of the weight in the S&P 500. So as the Magnificent Seven goes, so goes the S&P 500 index. Well, the S&P 500 equal weight index accounts for size by making every company in the S&P 500 have an equal impact on the return. So what you're looking at when you look at the index performance of the equal weight index is sort of the average return of the average market index participant. So in this case, it's showing a slightly higher, mostly in line with the S&P 500 index. That's a fancy way of looking at it to say that the size factor seems to be going away, that the idea of just Magnificent Seven seems to be going away. This is positive because if we look at different segments of the market, the small cap market, the mid cap market, international, what we're seeing is that the price to earnings ratios for those areas of the market, that is to say how expensive or cheap they are relative to their earnings, they are tending to be cheaper than large cap stocks, definitely cheaper than the Magnificent Seven, the largest of the large. So we think it makes sense that you have a diversified portfolio, that you're not just piled into the biggest of the big companies, because from one year to the next, leadership in returns changes. And this asset quilt shows you what we're talking about. So the way to read the asset quilt is to read from the top down in each column. And that's showing you a year by year look at the ranking of returns for that year among different asset categories. So you can see in some years, in the past several years, large cap has been the leader. But there are other years when small cap or international emerging have led, or that mid cap has done better than large cap, or international developed has done better than large cap. So we think it's important that if you have an investment policy statement and you have an asset allocation target, that it includes not just large cap stocks, but mid, small, and international equities as well. In addition to that, it should include fixed income. And I'm going to turn it over to Josh, who's going to talk to you about the fixed income market and the outlook there.
Thanks, Greg, for the smooth transition. So during this portion, we're going to cover some of the recent developments in the fixed income market, a little bit of expectations for the coming year, and maybe a little refresher on fixed income in your portfolio if we have some time and some quick learning topics. Then we're going to finish off with a little bit of Q&A, like Judy mentioned at the beginning of the webinar. So if you have any questions, feel free to type them in the chat, and either Judy will answer them or we'll get to them at the end of the session. So during our last market update, we talked about how significantly fixed income, and in particular long-term fixed income, had declined over last year. However, since then, we've actually seen that long-term performance rebound and finish the year strong, and we'll dive into that on the next slide. A lot of this volatility has been due to markets expecting what we'd call loosening monetary policy, mostly related to the Federal Reserve lowering interest rates. You know, Greg talked about this a little bit about economic expectations, and should we continue to see the economy get a little weaker, those interest rate cuts could very well happen. So on this slide, we have our graph showing the performance of fixed income over the past year, and we can use this to dive into a few areas that we just spoke about and that we think are interesting. First and foremost, let's look at the first row. This is the aggregate domestic bonds index, and that's overly complicated wording. What you can think of that is a snapshot of a large number of bonds across the spectrum of the United States. It includes treasuries, government agencies, mortgage-backed securities, corporate bonds, and because it encompasses all of these, it's a really good indicator of the overall bond landscape. And as you can see, the performance reached the bottom in October and November. That's that little orange section, and has recovered since then, reaching yearly highs at the end of the year. So next up, we're going to look at the high-yield corporate bonds, which is stay on that slide a little bit. We'll stay there. Yeah, thank you. The second row is going to be high yield corporate bonds, and these are bonds that have a lower credit rating because they're issued by companies with the lower credit rating, or because compared to a company's other debt, they're a little bit more risky. In particular, these bonds tend to move very closely with equities. As we saw earlier from Greg, equities performed very well. So these bonds had the highest return over the past year. And you can see that with the dark blue in December. However, if we see the economy weaken, this return could potentially decline. Next, we can take a look at the T-bills. That's about halfway down, and T-bills are issued by the government and have a very short maturity, less than a year. These bonds had much lower volatility than many of their counterparts. As you can see, it's just a steady increase from the beginning of the year to the end of the year. And even though it didn't rally as much as some of the other indices at the end of the year, they still posted gains because of short-term interest rates haven't yet fallen. Moving on to TIPS, some people might know these as Treasury inflation protected securities. These bonds are tied to inflation rates. The coupon rate, which is what you're paid periodically, is fixed, but the principal is tied to inflation. It goes up as inflation goes up. A lot of investors assume that in a high inflation environment, these bonds are always a good investment. However, although they did perform well, their returns are also driven by the same things a lot of these bonds are driven by, like interest rates. So you can see they have the same dip and rally at the end of the year that a lot of these other indices have. So while they could be good in a high inflation environment, it's not necessarily a guaranteed winner like some investors may believe. And finally, we're going to point out the last row is the 10-year Treasury bond, which have the longest maturity in the graph. And they sit at the bottom. These bonds because they mature further in the future, they're more sensitive to interest rate changes, which have happened a lot recently. They reached the lowest lows of any of the pictured indices, but also rallied some of the biggest rally at the end. So on the next slide, I do want to blow up two graphs that we just talked about just to make it easier to see, because I know they can get a little squished in there. And that's the 10-year, which is the longest one, and the T-bill. And since T-bills mature much earlier than the 10-year, both these indices actually ended up in similar positions at the end of the year. But the biggest difference in an investor's portfolio is the drawdown. For instance, if you're a retiree and you have to withdraw from your IRA or your TSP or what have you, and you have to withdraw in November, you might be losing a lot of value versus a short-term bond. This is why if an investor in the past has wanted long-term performance, they may take on that risk in those longer maturing bonds versus someone making regular withdrawals. They may want to keep a bigger portion in T-bills. That being said, it's also important to mention that in the less volatile fixed income market, those younger investors won't want to stay in T-bills for a long amount of time, because we've seen many studies where keeping your money in cash, and in this case, T-bills are considered cash, it could lead to underperformance. It's called loss aversion bias, and the investor is scared about losing money and doesn't take enough risks, so they underperform. So all of this begs the question, why have fixed income markets perform so poorly, especially since in the past we've thought of them as very steady and not losing as much value as they've lost in the past 2 years. This has been one of the worst bear markets for fixed income in the US. And the first domino, as most other things recently, was COVID. In times of economic shock, fixed income actually performs better as investors rush from equity to fixed income, and equity markets perform poorly. However, not too long after, we saw signs of rising inflation, which we hadn't seen in quite a while. The Fed called it transitory, saying it would go away soon, but soon reached levels that they couldn't ignore. When this happens, we see a fixed income perform worse for two reasons. First, inflation means your money doesn't go as far in the future. The principal payment you're expecting when your bond matures is going to drop in value. You're not receiving less money, but you get less eggs that you would buy at the grocery store, for instance, or those eggs are more expensive. And then secondly, inflation means the Fed is probably going to act to increase interest rates, because that's their tool for fighting inflation, and that's exactly what they did. For both these reasons, long-term fixed income starts to underperform. And when fixed income rates rise, we also expect the economy to start doing poorly. Think of it as putting the brakes on a speeding car so it doesn't overheat. Greg talked about this a little bit, and it's not as strong as it's been. A recession never occurred, so equities continue to perform well. If there was an economic recession, maybe we would have seen investors rush back into fixed income, but it never materialized. So we've discussed past performance, but what do we expect in the coming year? Not a bad place to start is where we see interest rates going. This slide has two curves. The yellow curve is of what the Federal Reserve has said they will do. That is, hey, we're expecting 3 rate cuts in the next year, and I think Greg alluded to that earlier. You can see they've communicated these cuts, but the red line is what markets are expecting, which is more frequent and or more severe rate cuts. At the end of the day, one is more likely to be correct than the other, but either way, if we do see rate cuts, we may start to see interest rates fall on bonds. And if we're in that position, individuals with those longer term bonds may perform better. This is the inverse scenario to where we're at right now. In the past 2 years, we're in a rising rate environment. The individuals with short-term bonds perform better. And the next 2 slides from Bank of America show similar statistics. The first slide shows investors expecting short-term rates in the next 12 months at almost 100%, which is pretty funny, but it's also not too surprising because the Fed literally told us, hey, we are likely going to lower rates. And a common phrase that you hear in investing is don't fight the Fed. The next slide shows investors expecting lower long-term rates, and even though it's a little lower than the previous graph, a significant portion still expect those long-term rates to fall. So on the next slide, this is a new addition to our visualizations. It's a dot plot, and it might go over some facelifts from now to the next quarterly webinar, but this is a good tool to see different yield curves for different products right now. This is something we look at when you want to invest in a client portfolio to see potential areas of opportunity. The vertical, the up and down axis shows yield, which is how much return we're going to get from the products, and the horizontal axis left to right shows how long it takes to mature. So in theory, the further you go to the right, the higher you'd want the yield to be because you're taking on more risk. So first, let's look at the green dots. These are the Treasury securities, and they're a little hidden by some of the other dots, but the interesting thing about them that you can still see is the shorter term Treasuries on the left side are actually yielding higher than the longer term securities on the right side. For a lot of modern US history that this curve has existed, when we see an inverted yield curve like this, we expect a potential incoming recession. However, it's been this way for quite a while and it still hasn't materialized yet. This is just another indicator of the soft landing that Greg talked about. If the Fed can somehow get that uninverted yield curve where we would normally see rates without entering recession, it would be considered a job well done. It also explains why some of these shorter term bonds have performed better in the short term because they're yielding more. You could also notice on the left-hand side, just looking at the 3-month column, which is that first dotted column, treasuries are yielding more than investment grades, munis, and everything else. We don't expect the federal government to not pay back their loans, so a company might have more risk of default, so we would expect them to yield more, but that's currently not the case. Corporate yields for lower rated investments, so that's the single A corporates, and they're the light blue on this graph. This curve, we're seeing what we'd expect, which is that the further out you get, the more the curve, the more yield you get. And it's possible this is because companies carry more risk. You can definitely expect that a federal government is going to be around in 10 years, but a small cap company might not be, so they have to offer more yield on their investments. And then the last item I want to point out is municipals, which are the orange dots. These bonds are yielding more than the other bonds at the 9 months to 10 to 5 years, which is a potential area of opportunity for some investors. However, these tend to benefit individuals with high state taxes, and even then you might be restricted to which ones you can purchase. So these are not recommendations, but definitely something we'd consider and something that's interesting to look at. So just to finish up the fixed income portion with a few learning opportunities and to expand our vocabulary in fixed income and our understanding of it. This first slide covers the basic question of fixed income. Why do some bonds yield more than others? Why are some bonds paying you more money to own? Why are some more expensive? So the first option to consider is interest rate risk. And what this is related to multiple things, but the main thing is maturity. If interest rates are rising and you're in long-term bonds, that could potentially lower prices because investors may not want to pay 2% for a bond when 3% bonds are now being issued without offering a discount. Another important factor is payments. You can think of a bond that has big periodic coupon payments as being shorter than the ones that mature at the same time. Why? Because you can reinvest those coupon payments next month when you receive them, even though it doesn't mature for a few years. Credit risk is another important one, and is how likely a bond is to default. Moody's, S&P, and Fitch are the agencies that give ratings to a particular bond offering. Treasuries are some of the lower credit risk ones, and what you would consider a high credit risk are senior loans, high yield corporates that we talked about earlier. Default is similar to credit risk. It's the risk that a loan defaults. A lot of investors invest in funds that have hundreds or even thousands of bonds to minimize this. Even if a single bond defaults in the portfolio, it doesn't impact the price that much, and it's almost expected. And reinvestment risk is kind of the opposite of interest rate risk. If rates are high and you have a short-term bond and rates suddenly drop, you're going to be wishing you had bought those longer term bonds. And then finally, prepayment risk is maybe the least common, but it's the risk that the issuer pays back to a bond, that an issuer pays back a bond before it's due. And this only matters for callable bonds, and a lot of bonds are not callable. So quickly, I just wanted to talk about aggregate bonds. We had some questions about, we talked about the aggregate fund and the aggregate index, but what is it actually made up of? There's a lot of funds, but this one here is just as an example. This first slide is an example of a potential bond index. It has about 40% treasuries, 25% mortgage-backed securities, and then the rest are filled out with corporate bonds, a small amount of agency bonds, and cash. And on the second slide, similarly, this is the same index. It's going to show how long these bonds have to mature. The largest amount are 7 to 10 year maturities, and also a lot of 3 to 5 year maturities. Typically, if you see an aggregate fund, they're going to have about 7 to 8% total in their duration or their maturity for the fund as a whole. And they can vary depending on what the fund is and what they're tracking. But if you have any other questions about these funds, feel free to reach out to myself or Greg and to speak about them, or your investment advisor. So on this last fixed income slide, just wanted to go over the role of fixed income in portfolios. It's basic, but it's a discussion we have with a lot of clients, and we touched on it earlier. First is diversification benefits. This chart here is a correlation matrix, and that's just fancy terminology for how closely two different assets move together. When we buy fixed income, we don't expect it to move with stocks one for one. When stocks go up, fixed income may go down, or vice versa, or maybe they move together, but stocks go up 100% and bonds go up 50%. Over the past few years, stocks and fixed income started to move together more closely. But if there is an instance where stocks fall, fixed income does give us that benefit of potentially being able to cash out of it without tapping into the stocks that are down. I tried to think of an analogy and I could not think of a very good one, but what I came up with is making dino nuggets and mac and cheese for your kid for dinner. And maybe they don't want mac and cheese today, but you can have the dino nuggets, and then tomorrow for lunch we can have the mac and cheese. It's there in case you need it, but if not, then it's still going to be there the next day. So the next reason is cash flows. Fixed income can pay you a fixed amount of cash on a reasonably knowable basis without having to liquidate portions of your portfolio. This could be particularly important for individuals that might not want to liquidate for capital gains reasons. If your money is tied up in a stock, for instance, that's gained a lot and you would have to pay a lot on taxes, it could allow you to liquidate more slowly and eventually pay less overall. And then finally, like we discussed earlier, TIPS provide a potential inflation hedge. Inflation can really destroy value in fixed income like we talked about, but TIPS give you, to an extent, it can be really impactful for retirees' portfolios. So before we get to the Q&A here shortly, we usually try to recap these meetings with some ideas for investors. And this time, a lot of these we try to focus on for the new year and making decisions heading into 2024. It's a little late to be making New Year's resolutions, but still got some great ideas that can be implemented any time of the year. First, rebalancing your portfolio is a really useful tool to make sure you don't stray too far from your objectives, especially after this past year where something like large growth stocks outperformed everything significantly. Investors might benefit from trimming where necessary and redeploying those assets into areas that are underweighted. We do this for our clients on a semi-annual basis. That way their portfolios don't get too risky over time, or even less risky over time. We could also consider extending bond maturities. We talked about this earlier. It's not a guarantee that long-term rates will fall, and past performance definitely does not indicate future results, as always, but we don't want to be too short when our bonds and have our bonds lose value when those rates do fall. Now's a good time to take a look at your portfolio and look at any funds that may have increased their fees. Maybe there's a thematic investing fund that's overcharging for a cheaper alternative you haven't looked at. Or maybe you're holding on to an investment that didn't pan out in the hopes it would rebound, and now it's time to exit the position. Ask your investment advisor about any of these ideas for your portfolio, or take a look next time you look at your portfolio. And for those of us taking required minimum distributions, we should make sure our tax withholdings are appropriate, especially if our income is changing for the next year. Would not like to be giving extra money when not needed. People like to get big refunds during tax season, but that's usually an indication that we could have potentially lowered our withholdings at some point. And then finally, consider a budgeting tool or a spreadsheet for the next year. If you don't use one, there are options for budgeting apps and tools that monitor spending, monitor your goals, but be wary of ones that charge high fees if you do keep money with them, because I know some of them do charge high fees. I prefer a spreadsheet, but I really like being able to manipulate the data more. So we will have another quarterly market update coming up next quarter in April. If it's on the website, it should be soon, as well as other events like an upcoming discussion on Medicare from partners Judy Barnhart and Jane Oshman-Rowney that I'm particularly excited about. So finally, with all that, we have a bunch of user submitted questions, and it looks like we got some. Did we get any in chat this time? We'll start off with the user submitted questions, and if you do have any, feel free to bring them up now. All right. So I think you touched upon this, Greg, if you want to expand on it, but Judith asked, how do you see the election this year as affecting the financial market?
Yeah, so you know, as that slide showed, post-election tends not to be a lot of movement. What that chart didn't show you was what's kind of almost I don't want to call it a law, but it is sort of a universal observation about markets, and that is when there's some kind of big news out there, the market tends to be more volatile, and if uncertainty is high, tends to draw down a little bit before the event actually happens. So in the case, for example, of a shutdown, the market tends to actually decline before we know whether or not there's going to be a shutdown. But once that information is out there, then the market, either continues on or moves up. But in the case of the elections, like I said, it didn't appear that one party sweeps had much of an impact on the market. And that it seemed like the market actually preferred a divided outcome. But even there, that wasn't a huge positive return versus kind of normal return periods.
Yeah, great answer. We have a more general question. This is from Haney, who asks if we expect the market in 2024 to be better than 2023. I know it's a little generalized, but do you have any thoughts?
Sure. So, one of the things I wanted to touch on when I was talking was that we expect to see earnings growth in companies that supports prices. Will that replicate the kind of end of 2023 returns we saw in last year? I mean, maybe not, but that doesn't mean that you can't still have a positive year. You don't. It isn't always the case that a very strong year is followed by a negative year. It may not be as positive, if the market for large caps is up more than 25%. What's the likelihood of you getting that when long-term, returns are on average, in the 8 to 9% range? It's probably not very high that you're going to get another 25% return, period. But like I said, with earnings support, depending on when the rate cut cycle begins, you could see a positive market going forward.
Yeah, absolutely. Here we have a question this is from Susan, I believe, and it asks about investing cash and where the best place to invest cash is. And I guess without knowing, the first thing that you'd want to consider when investing cash is what is your liquidity needs? Will you need the cash tomorrow? Do you want access to it at any time? And if that's your need, then you might have some options that are better than others. If you're looking for just what your highest yield could be, T-bills are definitely an option. They're considered cash. And if they're short enough, and you could look into getting there, but you may not have as easy access to selling them if you need them. I will say that a lot of big banks don't offer very good interest rates in their checking accounts, at least from what I've seen over the past year. So if you do have a checking or savings account, just make sure that you're getting some sort of compensation for keeping your cash there. I think so. We're running up on the clock here. I think we'll do one or two more and then call it. This next question from Elizabeth is asking about converting 401k accounts to a financial institution traditional IRA. It seems to be more of an operational question. Greg, any advice, or is that something that she should maybe talk to her financial advisor or us about?
Well, you definitely do want to do that. I don't think it's difficult to roll over, for example, from a 401k to an IRA. So that operationally, yeah, you can do it. What you need to consider and go over with your advisor is, what are the differences in my costs in doing that? What is the reason I'm doing it? You might be doing it because you want to consolidate under one manager, or you want to get more options than you can have in your 401k. There are a lot of different reasons. You're best off talking to your financial advisor about it.
Yeah, absolutely.
I'll just jump in there too, that the Department of Labor does require that when you are moving retirement money to an IRA, advisors now are required to, explain what those issues are to the retail consumer so that they understand the cost benefit of making such a move. And also there's legal just considerations in terms of what's subject to creditors and so forth. So it's definitely a discussion to have before deciding to move your accounts. We're just about out of time, but I don't know, Josh, there is one question in the chat that appears to be fixed income. Would you like me to read it to you?
Yeah, if you don't mind, I'm struggling to open up the chat for some reason.
Okay, it says currently in fixed income, taking an example of 5-year maturities, investment grade corporate bonds are yielding around 5%, whereas 5-year treasuries are yielding around 4%, resulting in just a 1% spread. This 1% spread seems quite low. So do you expect such spreads to increase? If so, how much?
Yeah, that's a great question. Right now, spreads are tight, and they have been tight for quite a while, I believe, since COVID, indicating that maybe you're not getting the best value if you are investing in corporate bonds. And typically, if we would see some more economic softness, I keep using that word, but if we would see a downturn, we would see the yields on those high yield corporates or investment grade corporates start to increase again. So you get more bang for your buck, so to speak. I don't anticipate too much economic softness, so I expect spreads to remain pretty close for now. But I guess we'll see in the coming year. Okay,
well, thank you both, Greg and Josh, for an excellent presentation. I think it was very, very useful and informative to all of our participants. And to our participants, thank you for joining us. And we hope to see you again, as Josh mentioned, in April. This is a quarterly market update that we have, and don't think we've set the date yet, but it will be on our website, and you'll receive alerts probably within the next couple of weeks for it. But thank you for joining us. Have a healthy and happy new year. All right. Take care. Bye-bye.